Okay, and let's just go ahead and take a look at the file. Get rid of this thing. Okay, so let's just go ahead and see what we have here. If you didn't pick up your midterm, please do so. They're up here in the front, this table right here. Okay. Okay, guys, class is in session now. Okay, so let's just go ahead and let's take a look at this first one. And the section of the Comprehensive Annual Financial Report that has all those tables and charts, everything you ever want to know about the government we're afraid to ask, was the statistical section, right? We had the intro section. The financial section contained most of what we were talking about, which was the MD&A, the general financial statements, right? Basic financial statements, including the notes there too. And then we had the required supplemental information other than the MD&A, right? Okay, but in that bottom section of the CAFR was the statistical section. Okay, good. Number 2, expenditures in a governmental fund would not potentially include what? For our grass funds, no depreciation, right? Okay. Okay, good. Number 3, which of the following is considered a proprietary fund? And that is going to be our internal service fund, right? Okay. Which of the following uses the flow of economic resources, focus? All of these were what? Were governmental funds, except our buddy, the internal service fund. For all our other funds in our government-wide, we use full accrual economic resources. Only the governmental funds use modified accrual and what? Current financial resources measurement focus. Okay. Okay, good. If you're just coming in, you can pick up your midterm up here whenever you get settled. Okay. Okay, number 5, in which of the following financial statements should a government not report depreciation expense? And that's going to be my governmental fund, which is my governmental funds, right? All these others will report depreciation, including government-wide. Okay, number 6, government-wide financial statements. And remember, I told you it's important to know all the names of the statements. We have statement of net position is the balance sheet. Statement of activities is the income statement, right? Okay. Okay, good. Number 7, when the budget for the general fund is recorded, the required journal entry will include, and remember, we debit our estimated revenue, right? We credit our appropriation, and then if we have a surplus, what should I do? Good. Credit budgetary control for that surplus portion, right? Okay, good. Okay, but this was just asking about the credit to appropriations. Okay, now we come down here and we say estimated revenues of the budgetary account is what? Debited at the beginning of the year, and then when we close, we simply do what? Reverse by debiting the appropriation, crediting the budgetary control, assuming we had a surplus and we're just reversing that entry up there, and then credit the estimated revenue, right? Okay. Okay, good. Just testing some basic understanding of governmental budgetary accounting. Okay, good. Number 9, which of the following is true regarding other financing sources and other financing uses? And remember, they have their own separate section down there on the statement of revenues, expenditures, and changes in fund balance. We have our revenues minus our expenditures, and then we end up with what? We end up with our other financing sources and uses section, which is like our non-operating items that then generate our change in fund balance, which is like our net income, right? Okay. Okay, good. Do you want to pick up your test? I mean, you might as well come in and pick it. Oh, okay. Only pick up your own test. Okay, those tests are the property of the individual that filled it out or my property, because potentially someone could come back and say, well, you never got my Scantron and my grade should be 100 and all that. So I need to maintain accountability over those. So please don't take anyone else's, okay? All right, number 9. Which of the following is true regarding other financing sources and other financing uses? Oh, we already said that, right? They're reported separately. Okay. Okay, good. Number 10. Under which basis of accounting governments should revenue be recognized in the period in which they are measurable and available? That was a modified accrual accounting rule that was just used for our governmental funds, right? Okay, the expenditure classification, public safety, is a function or program. Does the government keep you safe? Does the government keep you safe? Okay, things governments do are considered programs and functions. We also had what? We had character, which told us the period of benefit. We had, for example, current versus capital outlay. We had object class, which was like chart of accounts. We had what? Good. We had activity like patrolling, that kind of thing. Very good, right? Okay. Okay, good. So this one was just testing function for our different categories for our expenditures. Number 12, when supplies ordered for use in an activity accounted for in the general fund are received at an actual price that is more than the estimated price, the encumbrance account, and of course when we order the goods, we would do what? Debit encumbrance for 100,000. Credit what? Budgetary control. Good. For 100,000, whatever. And then it says it comes in at an invoice price that's more. So it says it comes in at 105. Well, what do? Debit bud control for how much? Debit bud control for what? 100,000. Don't start getting creative on me here now, okay? Credit what? Encumbrance is 100,000. We reverse for the original amount, right? And then debit expenditure for how much? 105,000, and credit cash or vouchers payable, whatever, for 105. Okay? Okay, good. Come over and let's take a look at the next one here. And number 13, it wrapped kind of weird on this version of the file. Number 13, the account interfund transfers would be classified in the general fund statement of revenues, expenditures, and change in fund balance as a, and remember we have the one other financing, what? Use is transfers out, and we have two other financing sources, transfer in and long-term debt proceeds, right? Okay, so this one is the what? The transfer in. It's another financing source, right? Okay. Okay, good. The County Commission of Benton County adopted its general fund budget for the year ended June 30th, comprising estimated revenue of $3,200,000, appropriations $2,900,000. Benton County utilizes the budgetary accounts required by GASB. The journal entry to record the appropriations. Let's do the whole thing. Debit estimated revenue for what? $3,200,000. Credit what? Appropriation, which was the answer to this question, for $2,900,000. And I have to do what? Credit bud control for how much? $300,000. Okay. And notice in this next one, I gave you the same fact pattern and just simply asked you for what? The credit to budgetary control, right? Okay. Okay, good. Come and look at number 16. Fund balance may be classified in all the following. And remember, we had spendable, recal. We had restricted, committed, assigned, and unassigned. And then, of course, we had non-spendable, right? Okay. And so uncommitted is a nonsensical category, isn't it? Okay. There is no category called uncommitted. Numbers, you can pick up your test. Which of the following will increase the fund balance of a government at the end of the fiscal year? And if the sum of my revenues and other financing sources is more than the sum of my expenditures and financing uses, more stuff coming in than going out. Okay. Now, what was the one that was causing you heartburn? What was your name again, sir? No. What was your name again? Huh? Todd, we were going back and forth on what? Revenues are more than the sum of expenditures, other financing sources, and other financing uses. And what I finally gleaned from this question after I kind of went back and forth on it a couple times, I'm like, what is that? When they say the sum of all those others, they don't mean the net of them. They mean what? The absolute value of all of them, right? And if other financing sources is some huge amount and the expenditures are smaller amounts, the amount of other financing sources could exceed the amount of the revenues, right? Which is kind of a screwy question, right? Because when we think of the sum, we as accountants think of what's been accumulated in the GL in those accounts, okay? So for this one, if you're here today, I'll add back 4 for this one because this is kind of a stupid question. I'll add back 4 to your score if you're here today. Huh? 4 points, I'll add back 4. You can write whatever you want on that Scantron, whether I'm going to do something with it or not. What I'm going to do is I'm going to go through, and if I am not in possession of a Scantron for you, I'll add 4 points to your score in Canvas. Thank you. That's what I have to do to get applause. I'm up here making recordings, going, having a heart attack over governmental accounting, and then you guys applaud me for 4 points. Thanks a lot. Okay. All right, so I'll just go ahead and I'll add those back, okay, for that one. That's a stupid question. The problem that I have is when I look at these questions, I look at the right answer, and I'm like, okay, yeah, right? I don't always read the wrong answers and identify the stupid choice that's down there. Okay, so whereas you read everyone. Okay. So the answer is what? The answer is A. I'll still add the 4. Just for inconveniencing you. Okay. Okay. Don't worry. This is not going to continue, this generosity. The next midterm is going to be much more interesting. To what do I owe this generosity? Okay. All right. So number 8, sorry. Okay. All right. So number 18 then. When computers are ordered by the mayor's office, the purchase order should be set up as debit encumbrance and what? Bud control, right? Okay, good. If supplies that were ordered by the department financed by the general fund are, I guess it's received at an actual price that is less than the estimated price on the purchase order, the available balance in appropriations will be what? Increase, right? Because we would have set up an encumbrance for, say, $110,000, but the stuff comes in for what? $100,000. Now we have additional appropriation available, right? Do I need to illustrate that? Okay. So if I'm sitting there and I order stuff for what? I'll put it on the screen. I order something for, let's say I have appropriation of what? Of 100,000. That's a credit for appropriation of 100,000. That's my appropriations. And so the balance in the appropriations ledger is how much? 100,000 balance. And then I go ahead and I order something. So I put an encumbrance in there, and I put an encumbrance in there, say 95,000. What's my available appropriation now? 5,000, good. And then when the stuff comes in, if it comes in at, say, 90,000, Okay, what's going to happen? I'm going to go ahead and I'm going to credit the encumbrance for 95,000, debit the budgetary control, and debit the expenditure for the actual amount now, which has turned out to be what, 90,000 in this little example. So now my available appropriation is what? 10,000, isn't it? Right? Okay, and so what's happened? The amount of the available appropriation has gone up because the amount that came in was less than what I encumbered for it, right? If you were a government official, would you tend to encumber for more or less than what you thought the amount was going to be? You tend to what? Encumber a little extra to give yourself a little cushion in case it comes in. You don't want it to come in at too much, right? Okay. Okay, good. Come over and let's take a look at what, number 20 now? Okay. Number 20, the expenditure control account of governmental entity is credited, and it's credited when we close the accounts at the end of the year, isn't it, just like in commercial? Okay, good. Stop me if you want to linger on any of these. 21, they give us these amounts, and they say, what should be recorded in the general fund and the enterprise fund for the increase in equipment during the year ended December 31st, and assume the electric utility is considered an enterprise fund. So what's happening? A village tax collector, that's going to be considered general fund. And the vehicles for the village electric utility, they told us that's an enterprise fund, isn't it? And we don't record equipment in the general fund. We would report equipment in an enterprise fund, though, right? Using full accrual accounting. Okay, so that was just saying what? Do you know which fund uses full accrual versus modified, and do you know that under modified we don't report equipment? And I think you've known for a long, long time since you were 2 that you report equipment under full accrual, right? Okay, okay, good. Let's take a look at number 22. And a lot of, like almost every time I gave this test, somebody came up to me and said, well, these are the same. 22 and 23 and 24 give you the same. And I'm like, no, they give you different choices, right? Okay, so the city of Grand, whatever, Maria's fiscal year end on June 30th. Grand Maria's uses encumbrance accounting. On May 6th, a purchase order was approved and issued for supplies in the amount of $6,000. What journal entry should be made to record the purchase order? Debit encumbrance, credit, budgetary control, right? And I thought I fixed this here, but I guess I didn't. On June what? 30th, okay, we never care about anything on the 20th of the month, okay, but on June 30th, at the end of the fiscal year, essentially, what entry would be made, and we would have to debit the budgetary control, credit the encumbrance for the fact that these things are the end of the year, right? We're going to close our budgetary accounts, thank you, right? And then what? For our real accounts, we're going to sit there and debit the unassigned fund balance and credit the assigned or committed. I'm assuming we didn't give you choice of committed, so we're going to just use assigned here, right? Okay. Okay, good. Then what? Using the same facts as question 22, what should be done on July 2nd? And you're saying, well, what's so special about July 2nd? Well, I guess the goods came in. The goods came in on July 2nd, and the only appropriate one was to debit the unassigned fund balance and credit the assigned fund balance? Huh? Oh, what is the answer? What's the matter?
It says the 20th on this one too. You're doing the 25th.
Oh, July 2nd. Okay, sorry. On July 2nd, debit what? Debit expenditure and credit the vouchers payable. And they told me it came in for the same amount, right? What other entry would have been made that day? Well, what entry would have been made on July 1st? I could ask that here. I'm going to debit the encumbrance for what? 6,000? Credit the budgetary control for 6,000, good. What else? Debit the assigned fund balance for 6,000. And credit what? Unassigned. So I'm putting everything back, right? For 6,000. And then what? Then when the stuff comes in, debit the bud control for 6,000. This is how governmental accountants keep themselves fully employed, right? Set up journal entries just to close them out, just to reset them back up again, right? And then debit expenditure, credit the voucher payable. Okay, good. Number 26. If the government uses the 60-day criteria for recognizing revenue under the modified accrual accounting, property taxes collected 90 days after the 2017 fiscal year end would be reported as revenue in fiscal year 2017, and we would what? We would adhere to the 90 days for our general fund using modified accrual. For our governmental fund, our government-wide funds, I should say, under governmental activities, we use full accrual. We are not bound by that 60 days, right? It's simply what? Time and eligibility, right? Okay. Okay, good. Now we come over, and for property taxes, actually, we don't have to worry about eligibility since it's property tax, so it's only time, right? And when use may begin. Okay. Okay, so you come over and you take a look. Which of the following types of non-exchange transaction recognize revenue when all eligibility requirements are met? We just said that for imposed non-exchange like property taxes, and we kind of called out property taxes twice there indirectly, right? And derived, which is our income tax, our sales tax, the government doesn't have to check itself for eligibility. It is only what? Time. Yeah, it's only time that we're worried about for our imposed and our derived non-exchange. For our voluntary non-exchange, eligibility does become an issue because they literally apply for the money, don't they? Okay. Okay, good. Notice we didn't mention here what? Government mandated. Government mandated could have an eligibility requirement when what happens? Usually for government mandated, we say, okay, there could be an eligibility. And remember I said it's a little weird if the higher level of government is telling us we have to do something and they're giving us the funding for it. We can't say no, so why do we have to worry about eligibility at all for our government mandated category? If it is what, guys? A reimbursement type grant, then what makes us eligible is the actual spending of the money, right? But other than that, there really isn't even eligibility very much for government mandated. So the only time that government eligibility becomes somewhat meaningful, really, is what? Is for our voluntary, right? Because we have to apply for that money. Okay. Okay. Good. Number 28. Huh? Not here, right? Okay, so what was 28? Anybody got the test? Here comes the prepared person. Ready? Which of the following are derived tax revenue? Income tax, sales tax, or both what? Well, no, income tax is income tax, and sales tax is sales tax. Income tax and sales tax are both what? Are both derived, aren't they? You guys can't see the question? It says, which of the following are derived tax revenue, income tax and sales tax? And the answer is C, both are derived, right? Okay. Number 30, which of the following is not a program revenue? And remember we said program revenue, we had the mnemonic what? SOC. SOC those away are what? Our charge for service, our operating grants, our capital grants. User fees are not considered a program revenue. Thank you. User fees are sort of like a what? A weird category of non-exchange. For example, a driver's license is that weird category in which we kind of basically wait till we get the cash. So the counting treatment is almost like how we would use for program revenue, but we don't consider it program revenue. We consider it sort of well, it's a user fee. It's kind of its own weird category of non-exchange. Okay, question? Okay, couple things, guys. This first test I went real easy because I gave you the answers in advance, number one. And the concepts were not that tough so that we get some, some momentum now going into the second round of discussions now for our governmental accounting. And we're going to spend quite a bit of time now understanding both the capital project funds and the debt service funds and see how those transactions that are accounted for those in those funds also get accounted for at the government-wide level. And it's not going to take long for this stuff to get weird on you if you take your eye off the ball. So you've done well so far by watching and seeing what we're doing and following up the lessons and asking the questions and watching the videos and whatever else you're doing. Keep up whatever keys to success that you've had so far. Those will continue to benefit you. If you take your eye off the ball and you start, okay, I got this, and Lord's going to give an easy test and give us the answers every time, you're going to be in for a rude awakening, right? Okay, so keep up your strong habits, okay? All right, good work. We are going to pause here, I guess. Even though it's a little early, it seems reasonable to do the break right now, and we will jump ourselves into Chapter 5, and if we find ourselves dying, we can take a second break, okay? So 1 minute, okay? So we'll get into Chapter 5 after we do some catch-up work from Chapter 4, because we didn't talk about how to account for inventory. Okay, so we sort of dealt with cash, receivables pretty much, but we didn't deal with other current assets such as inventory, such as prepaid items like prepaid insurance, supplies, that kind of stuff. Okay, so we got to round out that discussion of our current assets before we start talking about our capital assets and our capital project fund from Chapter 5. So let's just go ahead and take a look at this example. And I think I gave you a handout last time. Okay, it's this sort of long spreadsheet that I put up on Canvas. And it turns out that when we account for our inventory, GASB gives us two methods that we can use. Either the purchase method or the consumption method. So we've got two methods. What are they? Purchase or consumption. Now, GASB really, to be honest with you, like I wouldn't be honest with you, but what GASB does is they prefer the consumption method. This is more like the perpetual inventory system, but they allow companies, governments I should say, to use what? The purchase method if it's not materially different from the consumption method, and so we need to understand both for this class. Okay, so let's just look at the purchase method first. Okay, and when we look at the purchase method, when we purchase inventory for, say, $100,000, you see the city of Hayward had $100,000 cash, and before they purchased the inventory, of course, they had cash in an unassigned fund balance, right? They go ahead and they use up that cash to purchase inventory. They debit expenditure and they credit cash, right? So as soon as they're done with that, the cash is gone. And for a while, my balance sheet doesn't balance because I have to make my closing entries to make my balance sheet balance, right? We have to prepare our income statement. We close to the balance sheet, and then this thing will balance again. Now, we come down, and if under the purchase method now, $45,000 of inventory gets used, notice here, guys, no entry. We don't do anything because we've already taken that all to expenditure, haven't we? Okay. Now, you come down, and if you look at the statement of revenues, expenditures, and changes in fund balance now under the purchase method, I'm going to sit here and I'm going to assume no revenues, assume that the only expenditure was the $100,000 for inventory. We debit expenditure $100,000, didn't we? So we have a negative change in fund balance of $100,000, right? Do we have to close our expenditure account at the end of the year? On what planet do you not close your expenditure account at the end of the year? You always close your expenditures, your temporary accounts at the end of the year, your revenues and expenditures. So I have to close those, don't I? So what do? I credit my expenditures and we debit the what? Unassigned fund balance, right? You say on what planet? A world without accounting, John, where everyone's happy. What happens in a world without accounting? We're all unemployed. Okay, we don't want that. We're starting our acting careers. Okay, all right. So what happens? So we don't want that. So we debit the expenditure. We credit what? We credit the unassigned fund balance now, which what? Which closes my expenditure account, doesn't it? Okay, so I've seen my statement of revenues, expenditures, and change in fund balance. And when I get to the balance sheet, notice that what? Down here at the bottom of the balance sheet, my cash is 0. Oh, come on, John. One more thing. I get down here, and if I purchased 100,000 of inventory, and I used what? Good. I used 45, so you guys are with me. And I used 45. That means I have how much left? I have 55,000 left. And so when I count or whatever and I see that I have 55,000 left, Gatsby says, well, you got to bring that inventory onto the balance sheet as a current. I never know how to close it. It opens itself, and the only way I know how to close it is by coming out of tablet mode, hitting this, and going back to this, and somehow that closes. I'm going to disable that program. So it's useless to me because it does all this kind of stuff. Now my screen is screwed up, right? It's coming back. Okay, good. I don't know what all that is. Okay, good. So what's happening? So what Gatsby tells me is I have to do what? I have to set up my inventory on my balance sheet, don't I, for 55,000? Right? And so I debit my inventory 55,000. There's the inventory right there. That was that debit of 55,000 right there for the inventory left right there. And remember, we said that we always have to show a match between my inventory and my non-spendable fund balance, don't I? I always have to show that match, so I credit the non-spendable fund balance 55,000. Does it match now? Does it match? Does it match? So we're done with this. You just want to read this on your own and look at it? We'll just go on to the slides for Chapter 5. So we're done with this? I'll just give you like 50 questions. I'll make the whole test on this next time. Does this match? Because I sat there and I did what? I just debited the inventory and I credited the non-spendable fund balance. Didn't I to set that up? If you're waiting for a deeper meaning, stop. I just have to do this. I have to count the inventory that's left. I have to debit the inventory for 55,000. I have to credit something. I credit the non-spendable fund balance for the amount that's left, right? Okay, good. Now what happens? Now I look at my balance sheet and it balances, doesn't it? Inventory 55,000 and this non-spendable fund balance for 55,000, right? Now, that I just want to make sure we understand here how the unassigned fund balance got down to 0. Remember, it was up there for a minute, and everybody was probably panicking. The accountant and you was panicking a little bit because you're like, uh-oh, the balance sheet didn't balance there, did it, after I spent the cash? But when I closed out my expenditures, I did what? I debited the unassigned fund balance for 100,000. That debit closed it out to 0, so it's 0. And the non-spendable fund balance, I credited it, so it's showing the credit of 55,000, and there's the debit to inventory for 55,000. So everything ties up, right? Yes, sir.
Where did you debit the unassigned?
I debited the unassigned when I
Okay,
closed my expenditures right here. Because I had to close the expenditures, right?
thank you.
Okay. So, couple of takeaways from the sometimes I have to remember what they call. I always seem to forget what they call these two methods. The purchase method. Couple of takeaways from the purchase method, which is what? When you buy the inventory, you treat it as an expenditure, don't you? Okay, but at year end, you don't do anything when you use the stuff, but at year end, you have to make an adjustment for what's ever left by debiting your inventory and what? Crediting your non-spendable fund balance for what's left, right? With me so far? Okay. Okay, good. Now, if you are dealing with the consumption method, and what I'm going to do, and I don't know that you have this, but it's up on Canvas. You can just look at it. I'm just going to go to here to show you the way the purchase method works. Because I used to go through this whole big cumbersome thing, and then I realized, well, wait a minute, just buy into the idea, John, that the consumption method is like the perpetual inventory system. Okay, and so we'll update inventory after each what? An expenditure after each use, after each purchase, and then use of the inventory, right? So if you look at this, it's very simple. For the purchase method, you debit inventory, you credit cash, just like you would in commercial, right? As you use up 45,000 of it, what do? You debit the expenditure and you credit the inventory, right? Now, if we're looking at the inventory account now, it's got what we wanted at 55,000, right? Okay. Then what happens? Then I go ahead and I still need to sit there and close out my expenditure for the period. So I'm just going to go first down to my closing entries where I'll debit the unassigned fund balance and credit the expenditure, right? Actually, no, I don't want to go down to that. Pretend I didn't say that. Delete that, delete that. Okay. All right. So as I use the inventory, I do what? Debit expenditure and credit inventory, right? And since it's a perpetual system, at the same time, I would go ahead and update my fund balance. So now what? Because when I bought the stuff, I had gone ahead and taken the money out of my unassigned fund balance and set up my non-spendable fund balance when I bought the stuff. When I use this stuff, I also update my fund balance by debiting the non-spendable and crediting the unassigned fund balance, right? Okay, and then when I make up my closing entry at the end of the year, I debit the unassigned and I credit the expenditure. So if we analyze the unassigned, what happened? It started out with 100. We debited it right there because we updated the fund balance when we purchased the stuff. So it went to 0 for a second. And then what? Then we went ahead and when we used up some of the inventory, we also updated the non-spendable fund balance and the unassigned by doing what? Crediting the unassigned back. So now it has 45,000. And then at the end of the year, we did what? We closed the unassigned by debiting the unassigned and crediting the expenditure. So the unassigned still ended up with 0 in it, didn't it? And the what? The non-spendable, we originally credited it for 100, and then what? Then when we used some of the stuff up, we debited it, so it had the balance of 55,000, and the what? Inventory has the balance of 55,000. So that's why I say on the previous slide, you do what? You end up with the same balance sheet, don't you? Balance sheet looks the same under both methods. There's inventory 55,000 and what? And a non-spendable fund balance of 55,000, right? The only difference was how we got there, and it was simply by updating the inventory count and the non-spendable fund balance as the year went on as we made the transactions. When we first got the stuff, we went ahead and we set up the non-spendable fund balance. When we use this stuff, we debit and the inventory. When we use this step, we debit expenditure, we credit the inventory. Then what? We update the non-spendable fund balance by debiting the non-spendable and putting that stuff back in the unassigned fund balance. But then, of course, the unassigned fund balance is going to be reduced by the expenditure for the amount we used, right? So it ends up being a wash on the unassigned fund balance also. Okay, so some of the key high points of the, what is this, the consumption method? Purchase method? I don't know why, I can never remember the name of which method. I've only been doing this for like 30 years. What's the name of these two methods? Under the consumption method, we do what? We set up the inventory at the beginning of the year, just as you would in commercial. As you use the stuff, you debit expenditure, you credit the inventory, right? And as we go along during the year, we're also updating the fund balances. We first set it up as non-spendable. As we use some, the amount that we use comes out of the non-spendable and goes back into the unassigned. And then what? And then at the end of the year, the unassigned is going to be closed out for the amount of expenditure. So the impact on unassigned is zero, isn't it? As we use the stuff up. And what? Both methods have the same balance sheet, don't they? Do they have the same statement of revenues, expenditures, and change in fund balance? This is an interesting dilemma with inventory in what? Notice my statement of revenues, expenditures, and change in fund balance shows something different if I'm using what? If I'm using my consumption versus my purchase method, right? Under the what? Under the purchase method, really my expenditures are overstated, aren't they? My expenditures are overstated. Okay. Under what? They're correctly stated under the consumption method. That's why FASB would prefer that you use the consumption method. But they basically say that if my inventory kind of doesn't change much from year to year, it doesn't matter that much, right? Because it's going to, both methods are going to be pretty much consistent between the 2 years, between the different years. So they say it's okay if it's not material. Okay. Okay. Any question on that? All right. I'll have a full problem on that on the exam. No. We'll have a couple multiple choice questions on that. Any question on that? I can close this? Okay. Might as well save that. Okay. What time is it? What time do we get out of here? 8:45. Okay, good. We got lots of time. No, it's not 8:30. Don't make me mad. I'll keep you here till 9. Okay. The Giants are out of it. There's no game to watch. Okay, so let's go ahead. Now I hit a sore spot, right? Okay, so let's go ahead and let's take a look at chapter, it's chapter 5. Ugh. What chapter? 5. Don't worry about all those other B's and 6, 7s and stuff. It's just chapter 5, straight chapter 5, okay? And let's just go ahead and let's take a look at what we're going to be talking about here. And we're going to be talking about now longer-term assets. What happens when the government purchases now, not things like inventory and dealing with the receivable, tax receivable, and dealing with cash. What happens when we work our way down the balance sheet now and we start dealing with things that are more longer-term items, our fixed assets? We're going to see that at the government-wide level, we're going to do just like you've done in commercial accounting for all these years. You're going to set up fixed assets, right? But if we're at the individual fund level, do we record fixed assets? We do not record fixed assets at the individual fund level. Someone saw one time I was in some meeting and I was getting a little bit heated with the agency because the agency was sort of disagreeing with our findings. Meanwhile, I knew we were right about what we were saying, and they were kind of giving me some pushback on it. So I'm making my point and I'm arguing. And when we got out of the meeting, somebody said, John, I couldn't concentrate on what you were saying in there because all I could see was this one vein moving around in your head the whole time. That was you just going. I thought you were gonna have an aneurysm. So, okay, so I give you that look. You don't know that fixed asset. Well, you don't record fixed assets at the governmental level, right? Okay, so no fixed assets at the governmental level, but we are going to report them at what? At the government-wide level, right? Okay. All right. So let's just go ahead and let's take a look and see how these different assets will work. And we're going to have to get money for these. And typically, the way we get the funding for them, the key ones that we're going to look at are tax-supported bonds. Sometimes the federal government will give money for these things, particularly if we're going to build some sort of highway or something like that. The federal government has a highway trust fund that is used to provide funding to the state and local governments for construction of these different things. You know, everybody sits there and says, oh, yeah, the federal government just balance the budget. Yeah, well, what do you want to balance? You know, what do you want to take away? You want to take away the money that they provide to build a bridge so you can get to school in the morning? I don't think so, right? And so what happens? We start getting money from the federal government for these, the state, okay? We could get transfers from other funds, okay? We could have special assessment bonds. We could get funding through capital leases. Have you guys studied the capital leases yet? Raise your hand if you studied capital leases. Good. You guys will do well on the exam. Okay, the ones that haven't studied capital leases are going to be in trouble. Okay, I'll explain it to you. It's not a big deal. Okay? All right, so we'll go ahead and we'll take a look at these different sources of funding. Okay? Now, when we look at this, we're going to see that we can acquire assets from the general fund, special revenue fund. Capital project fund is basically going to be the fund that we're going to study here, and that they are going to be the ones that are constructing a fixed asset for us that'll be used for general uses, and we're going to study how that gets accounted for. Okay, so we're going to follow cost principles when we purchase items, which is what? Invoice plus what? I was just talking about this with my accounting, my business 20 students, business 120, were, sitting there saying, how do you handle delivery charges? It's part of the asset, right? Okay, they thinking you're going to expense it, but if you pay the amount for delivery charges, reasonable fees to bring the asset to use, that's capitalized as part of the asset, right? You've known that for a long time. Okay, so you come over and we say that we're going to record our capital assets at the government-wide level now. We report those as part of our governmental activities. At the government-wide level, they are what? They are depreciated. At the individual fund level in the governmental fund, they are an expenditure, right? And so they're going to be showing us this dual track accounting thing where they're going to be going on about what? How they will make two sets of books, essentially, one at the individual fund level, one at the government-wide level. The reality is, and I'm going to say this one more time, we would have an adjusting worksheet, a consolidating worksheet, in which we would go through, and if we debited expenditure at the individual fund level, we would credit that and debit what? Debit equipment to turn our individual fund modified accrual statements into government-wide statements, right? So just keep that always in the back of your mind. Okay, good. So there are certain assets that aren't depreciated, like land, for example, is not going to be depreciated. Okay, good. Now, what about works of art? Should we capitalize something like a work of art? A historical treasure. Anybody ever actually been to Hayward? I've talked about Hayward in here. What happened? You got lost on the way home? Huh? You live in Fremont, so you're close enough to Hayward, right? Okay, so did you ever visit the Hayward Historical Museum? Okay, on Mission Boulevard, you go and you visit the Foothill, on Foothill, right before the freeway, there's a historical museum. It's got everything about the history of Hayward in there. It's got so much about the history of Hayward that you'll spend 20 minutes going through that place, okay? And if you go all the way to the back, there's 3 pitchforks that were used to start Hayward. There's a golden pitchfork, a silver pitchfork, and a bronze pitchfork. And these pitchforks were used to start Hayward. Okay? Should Hayward capitalize those pitchforks? Should they put them on their balance sheet? Huh? On their statement of activities. Let's see what they tell us. They say Hayward is encouraged but not required to capitalize a collection if they meet all of these requirements, which is the collection is held for public exhibition, it is cared for and preserved, and the government, Hayward, has the policy of what? They sell one of those collection items. They have to use that collection item to do what? Purchase other collection items. And if they meet those three criteria, then they don't have to put the pitchforks on the financial statements, right? So when we're talking about historical treasure, works of art and that, we don't have to put that on the financial statements if we meet all three of these criteria. If we don't meet them, then what? Then we do have to put them on the financial statement, right?
Is it like just exchanging the like items for C?
Not really, no. I mean, if we use the proceeds to purchase other collection items, it's not even a transaction. We don't even have to record it. It's not on there. Where we had like-kind exchange, for example, and say no cash was involved, we wouldn't recognize a gain. We would simply debit the old assets for its book value, and if you say it was similar or like-kind exchange, we wouldn't even recognize a gain for that. We simply bring the new asset on the old asset's book value, right? Okay. Okay, so what happens? We're sitting here. We have to meet these criteria not to record those assets, right? Okay. What was your name, sir, that hangs out in Hayward?
Victor.
Huh? Victor. Victor, there's no pitchforks back there. Okay. All right. I just have to make sure I say that because I had someone said, "Oh, I didn't see. I went. I didn't see I didn't see the pitchforks. Where should I be looking?" Okay. I thought everyone knew it's a joke, so there's no pitchforks there. But Hayward's still a great place to hang out, isn't it? Yeah. Okay. All right. Okay. So let's go ahead and let's take a look at now what happens if we have certain infrastructure assets. First off, we should know that what are infrastructure assets? Infrastructure assets are things like roads, bridges, gutters, drainage systems, dam systems. I don't mean dam systems. I mean damming systems, water delivery systems. Do you guys get Hetch Hetchy here? No, right? Hetch Hetchy water delivery system is, in Hayward. Okay, Hayward gets it. San Francisco Water. Hayward gets it because they ran the pipes through Hayward. So Hayward, they poked a hole in the pipes, and people in Hayward have to come and hold a bucket there to get their water out of there. It's not quite like that. One time, I was doing some work where we were looking at funding that is provided to native Indian reservations by the federal government. So we go into these meetings where we meet with native tribes and stuff, and they're none too happy with the federal government, right? And so they start saying, "Your government and your government did this," and I'm thinking to myself, I'm Puerto Rican, okay? But anyway, so we sit there and we have to listen to a lot of different concerns, and they have real problems: high level of diabetes, no water systems. Okay, so they say that we have to get water from a water buffalo. They're telling us in the middle of this meeting, and I'm like, excuse me, because I got stuck taking the notes in that meeting, so now I got to write, gets water from a water buffalo. Well, I know I can't leave that in there and not explain what that means. So, excuse me, how do you get water from a water buffalo? And I guess it's just a big tank where they have to go and get their water because there's no running water systems and stuff. So it's really very irritating when I listen to some of these, discussions about what the federal government should be doing. They say, well, they should cut funding. Meanwhile, there's people sitting out there with no water systems, right? It's having to get water from a water buffalo. Okay, but anyway, so what happens? So things like that are all infrastructure assets, right? Okay, and the government puts these in place and they own them. Okay, so the question is, does the government have to report those infrastructure assets on their balance sheet? And the answer is what? Yes, they do. Okay? So governments need to report all of their assets on their government-wide financial statements as an asset. Do governments own buildings? Do governments own buildings? They have to report those buildings. Now, how do you know if a government owns a building or not? How do you know if the government owns a building? They often put their name on it. They say City Hall, whatever, right? Okay, so you know that the government owns buildings. Does the government own buildings and they don't put their name on it? Does the government own a building and they don't put their name on it? Yeah, they do. I was on an audit one time where the customs was keeping their seized drugs in a particular building in San Francisco. We got put on the job to go and help them count the inventory of the seized drugs. So we go in and you go into this safe and there's all this marijuana, bags of heroin in there that are seized drugs that they're holding them until they finally, have a party. No, they're holding them until they finally have the case where they're going to sit there and prove that as evidence and stuff. So we're going down the inventory listing and they can't find a bag of heroin. And I'm like, well, this is supposed to be an easy assignment. Now there's a missing bag of heroin all of a sudden. So I'm telling the guy, well, where is it? He starts getting defensive. And I'm like, no, you got to find that. So we found it was in another safe. We were able to find it and account for it and reconcile that it was all there. And when we're walking out, everybody's like, hey, John, I like the way you stood up to that guy. You know those guys are armed, right? And I'm like, no, I did not know they were armed. I would have said no problem with you can't find the bag of heroin, you can't find it. Okay, so whatever. Governments don't necessarily put their names on buildings and stuff that they own, right? But infrastructure assets, you know they own them, don't they? Okay, does the government own a bridge? You know they do. If somebody tries to sell it to you, don't buy it, right? That belongs to the government. So what happens? Governments need to put all of those assets, buildings, bridges, everything, they need to report those at the government-wide level. Okay? Now, for buildings, equipment, things like that, the required approach for everything is that they depreciate that. Now, what happens? A lot of governments got upset with GASB when they told them that they have to bring their infrastructure assets on the financial statements and depreciate them. Think about it. If you're New York City and the Brooklyn Bridge been out there since the 1800s, now I got to not only value it and bring it on the financial statements, but I got to tell you what the depreciation is on that. They're like, you're killing us, GASB. So GASB says, okay. For infrastructure assets, we will allow for the modified approach. And under the modified approach, you still have to capitalize that asset, but you do not have to depreciate it. Any money that you spend on that is for maintenance type thing, you can just treat it as an expenditure, and you don't have to capitalize. Now, if you add a wing to a bridge, like they did with the San Mateo Bridge, not a wing, but a lane to the bridge or something like that, then what? Then that needs to be capitalized, but you do not have to depreciate for ongoing maintenance costs. You just do what? Treat those as expenditures, and you don't depreciate. Okay? Now, in order to be eligible for the infrastructure approach, you have to meet certain requirements. One, you have to have an up-to-date inventory of your eligible infrastructure assets. You have to provide a condition assessment, and you have to estimate each year how much you need to maintain that condition assessment. You also have to have documents that support that you are supporting carrying your infrastructure asset at the assessed condition level. So in order to be eligible, you have to be part of a system of infrastructure assets, and you have to meet these requirements. Okay? So the most important thing is if you choose the modified approach for infrastructure assets, you have to have 2 RSI schedules. What is RSI? What is RSI? Required supplemental information. Is the MD&A RSI? MD&A is RSI, and then what? We have that bottom section that's also RSI. Then what I'm giving you right here is an example of something that's RSI, that bottom section, if a government chooses the modified approach for its infrastructure assets. Modified approach for infrastructure assets like bridges, etc., is what? Is meaning that I am not going to have to Depreciate it, right? Okay, so what are my RSI schedules that I have to, Oh, I guess I have to write those. 2 RSI schedules. I thought I had that in here somewhere. 2 RSI schedules. One schedule uh, 2 RSI schedules. One schedule is providing a condition assessment of the government's infrastructure assets. I would have sworn I put that in here. One is what? Providing a condition assessment of the government's infrastructure assets. Okay? So you will literally sit here and show it, for example, 10,000 miles of road, and you'll say good condition. You'll say 15,000 miles of road in fair condition, and you'll say 100,000 miles of road in what? Poor condition? Well, I'm not saying it has to be 100,000 miles of road. I mean, this is potential, though, right? That we could have a city, whatever, which has a lot of road in poor condition, don't they? This is the condition assessment. That's one of 2 RSI schedules. So we got one. What's the second one? Second one, huh? What? You talking to me? What are you saying? Yeah, where'd you see that? Is it up here? Yeah, okay. Well, it's kind of saying that, but it's not saying in the format of an RSI schedule. The second RSI schedule is going to be a what? Comparison of amounts needed to maintain condition. Comparison of amounts needed to maintain condition versus what? Versus actual. I'm going to read that back to you. Comparison of amounts needed to maintain condition versus what? Versus actual. So what happens? Go back to this 10,000 miles of road in poor condition. 10,000 miles of road in poor condition. And we need to amount needed to maintain what? What condition are we in? Poor. Amount needed to maintain poor is 10 million versus the actual that was spent, which is 7 million. Do you want to ride in the roads in this town? How much do we need to maintain poor condition? Amount needed to maintain poor is how much? 10 million. How much are we going to actually spend? 7. Do you want to drive in the roads in this town? You do? Why? What do you like, bumpy roads or something? I need to spend 10 million to maintain poor. What was my actual? 7 million. They're bad and they're getting worse, aren't they? They're bad and they're getting worse. Okay. What? You're thinking, oh, I don't want to drive there, right? They're bad and they're getting worse. And so what's happening? If a government reports, they think about what's going on here. The government decided, okay, I don't want everybody to know that my infrastructure is rapidly depreciating, so I'm going to take the modified approach. Well, what will happen? They'll have to provide these RSI schedules that will give a condition assessment and tell everybody what the condition assessment is, how much they need to spend to maintain in this example, poor condition assessment versus how much they're actually spending. So you would be able to figure out that you have a rapidly deteriorating infrastructure, wouldn't you? From this one? Okay. And so if a government thought that they were going to hide something by the modified approach, well, maybe they are, because you have to be some sort of nerdy accountant to know that you have to get down in the RSI information and look for these two schedules. But you would figure it. You could figure it out, couldn't you? Okay. Question. This is an area where you hear the candidates for president every now and then. They mention, we're going to invest in infrastructure. You keep hearing them say that. Okay, the idea that what? The federal government can help the economy along by doing what? Investing in infrastructure, because then people have to work to fix these poor assets, right? I think Trump missed a golden opportunity to have a major campaign issue here. I don't know why he wasn't all over this. What does he do? What does Trump do? What is his business? He's a builder, isn't he? I mean, he should have been all over about how he can fix the infrastructure and put everybody back to work through fixing the infrastructure by doing this, that. Meanwhile, he's talking about who knows what, all this crazy stuff, right? So I don't get it. But and I'm not rooting for him, but I just don't understand why he didn't get it. Every now and then, Hillary mentions what she's talking about doing. She actually articulated a better plan than he is about some things she thinks the federal government can do to help with this kind of problem. Okay, but these are infrastructure assets. We do what? We have to report them on our balance sheet at the government-wide level because they are assets, right? But we don't have to depreciate them like we do our other assets if we choose the modified approach, right? And if we choose the modified approach, we pick up these two schedules that we have to prepare, which is what? One schedule listing the condition assessment, the other comparing the actual versus the need to maintain that condition assessment. Okay? Okay, good. Come over then, and let's take a look at some transactions now where we're going to be purchasing our equipment, etc. And we purchased a piece of office equipment, and in the general fund, we've known for a long time now you debit expenditure and you credit cash, right? Okay. If we are sitting there and accounting for that same transaction at the government-wide level, we would debit equipment and credit the cash. Again, using this dual track approach, and you've heard me say now, I'm not going to say it again about the adjusting entry we would make, right? If we were really doing this for real. Okay. Okay, good. Now you come over and accounting for capital leases. Okay. If we acquire an asset and we have met the criteria for a capital lease, we will treat it as a capital lease. Now the criteria that the government uses are the same criteria, holy Toledo, that we use if we are dealing with a commercial enterprise. Don't worry about trying to see this slide, guys. I'll just tell you right now what the criteria are. There are 4 criteria in order for something to be treated as a capital lease, and this is something that's going away pretty soon even for FASB, and I'm not sure what GASB is going to do with these criteria, but for the capital lease, we have 4 criteria, which is there has to be any one of these 4, an ownership transfer, what? There has to be a written bargain purchase option. The present value of the minimum lease payments has to be greater than or equal to 90% of the fair market value of the property, or the term of the lease has to be greater than or equal to 75% of the economic life of the property. And if you meet any one of those criteria, you have to treat that as a capital lease. And you can remember those using this mnemonic: owns, ownership transfer, written bargain purchase, present value of the minimum lease payments is greater than or equal to 90% of the fair market value of the property, term of the lease is greater than or equal to 75% of the economic life of the property. If you meet any one of those criteria, then you would be treating this as a capital lease. Okay? And the only reason I put this slide in here from GASB is because I think I had a student that argued with me and said, those aren't the criteria for GASB. And I'm like, yes, they are. Same criteria. Okay? All right. So don't worry about the criteria. Once we meet the criteria, we will treat this item as a capital lease by calculating the present value of the minimum lease payments and taking the present value of the minimum lease payments and debiting expenditure and crediting other financing sources. The criteria doesn't matter here. You're simply going to do what? Debit expenditure and credit other financing sources if you have acquired this property under a capital lease. Now, a capital lease is long-term financing, isn't it? Isn't a capital lease long-term financing? Okay, and so when we purchase something under a capital lease using full accrual accounting, we are supposed to debit equipment for that purchase, say $50,000, and credit obligation under capital lease for $50,000. That's the transaction that we make when we acquire an asset under capital lease. Is equipment a long-term asset? You're kidding, right? Is equipment a long-term asset? Yes, it is. Equipment is a long-term asset. Is an obligation under capital lease, if it's a 5-year lease, let's say, is that a long-term asset? Is that a liability? Long-term liability? So these are both liabilities, aren't they? Okay. All class long now, we've been saying that when we acquire a capital asset, what do? In our governmental fund, in our general fund? Trust me, don't listen to this. Think that this is the time to start sneaking away to do a text. And I'm going to put a question on the board here in a minute, and you're going to go, oh, no. Okay? So when I acquire a capital asset, say in my general fund, what am I supposed to do? A long-term asset. What journal entry do I make? Well, assuming that I don't worry about the encumbrance right now, but thank you for being thorough. What do I debit when I receive this stuff? Don't worry about the encumbrances. I debit expenditure for $50,000. If I have long-term financing, what do? Like a bond, long-term financing. Huh? Good. I credit other financing sources, but now it's not a bond. It's what? So capital lease, whatever. I can put whatever label I want on it, but it's still going to show up on the statement of revenues, expenditures, and change in fund balance down in the non-operating section. Is that the journal entry that's up there? So if I acquire equipment under a capital lease, what happens? Under modified accrual accounting, they're saying I'm in the special revenue fund. I'll debit expenditure. I'll credit other financing sources, right? Because I'm getting a what? Long-term financing? going on here? Now, if I'm reporting that same transaction at the government-wide level, and I've already written it up here on the board, we would debit equipment, credit capital lease obligation payable liability, just like we would in commercial if we were doing this, right? At the government-wide level and we're doing full accrual accounting. With me so far? Okay. Let me ask you this. What should I do when I start making the lease payments? When I start making the lease payments. Let's say the interest rate on this lease, and I'm just going to use 10% to keep the numbers easy. Let's say the interest you don't buy anything with an interest rate of 10%. Let's say that the interest rate on this thing is 10%, and the payments that I have to make are, say, we'll make it $15,000 a year on this thing. Okay, so if I'm accounting for this at the governmental activities level, and the obligation was how much? 50,000. I'm going to take that 50,000 times what's the interest rate? 10%. That's what? 5,000. How much did I say the lease payments were? 15,000. Okay. So I'm going to go ahead and I'm going to credit cash for how much? 15,000. I said the payments were. I'm crediting cash for 15,000. Why are you skeptical on that? If I'm paying the cash, it's a credit to cash for 15. How did I get the what? 50,000? I made it up. I fell off the bed last night and I hit my head on the side of the table and 15,000 came out. Okay, so it's what? 15,000. If you're saying, hey, that won't be amortized properly, if that's what you're saying to me, I don't care about that. I'm not trying to amortize it. Okay, so I'm just sitting here. I'm just making the numbers up. That's how you would pay the cash payments. So I made that up. So it's 15,000 is the cash payment. You want a different amount?
No.
Okay, so the cash payment is 15,000. How much is the interest? Interest expense then, right, is 5,000, isn't it? And then I'm going to debit this what? No. Come on now, don't be making things up. Obligation for the lease. This account right here, right? It's this account right here? Hello? For what? Interest expense is 5,000, and I debit the obligation for what? 10,000, because that part of the payment that isn't paying interest is paying down the principal, isn't it? Right? Okay. What entry should I make for, if I'm doing that at the government-wide level, what entry should I be making at the individual fund level? Start with the easy one. What's the easy one? Credit cash. Good. For how much? 15,000. What do you want me to debit? What have I debited every single time when I've spent cash? It went for on a long-term item. I debit what? Expenditure for 15,000, right? For 15,000. Credit cash, debit the expenditure. Looks like I'm trying to debit both of those. Credit cash, debit the expenditure. Hello? With me so far? Now, you look at this, and you're sitting there saying, well, that's weird. You debited expenditure when you bought the stuff, and now you're debiting expenditure again when you pay the lease payments, aren't you? You're double counting the expenditures, John. That can't be right. Okay. Let me ask you something. When I made this entry right here, did my fund balance go up or down? The entry that I made when I acquired the equipment under this lease. Did my fund balance go up or down? I've got to vote for up. Do I have a vote for down? Did it go up or down? When I have an expenditure, does that decrease my fund balance or increase it? Decreases it. Do other financing sources increase my fund balance or decrease them? Other financing sources. They increase my fund balance, don't they? So this is a wash on fund balance at the time that I acquire the asset, right? Because I acquired a resource, this equipment, and I did what? But I didn't expend any current financial resource like cash, so it's a wash on fund balance, isn't it? Right? Did my fund balance go up or down when I went ahead and started making the lease payments? Now it went down. Why did it go down? Because I've used, I should say, what? A current financial resource, didn't I? So this is falling under the current financial resource. This approach is falling under the current financial resources measurement focus, isn't it? Okay? Okay, so what's the takeaway here? Full accrual accounting, governmental activities, just like you would in commercial. You take a look at the present value of the minimum lease payments. That's what you bring the equipment on. You set up a liability for that, don't you? Right? As you start to pay on those lease payments, there's going to be an interest rate associated with that. And so part of your payment goes towards interest, part of your payment goes towards principal, doesn't it? Just like you would in commercial. If we're accounting for that same set of transactions at the fund level, when we acquire the equipment, since we don't treat acquiring equipment as a capital asset, we debit expenditure. Since we have long-term financing, we use what? Other financing sources, don't we? That's a wash on fund balance. And then when we start making the payments, of course, we credit the cash, we debit expenditure again, don't we? Okay? Okay, good. Because a lot of students struggle with this because they don't bother to study this thing at all, and then they start seeing something like that. Because I could very well give you a test question where I'll say, which of the following entries would be made for the acquiring of a capital lease? And there's going to be this debit to expenditure at first, and then a debit expenditure again, and you're going to go, that. Some people are going to look at that. The non-Scantron picker-uppers today are going to look at that and say, no way, you can't debit expenditure twice. Yes, you do. Okay? Okay, good. Okay. How about when we dispose? What time do we get out? Why does it seem like we've been talking longer than that? Okay. So what happens when we go ahead and we dispose of an asset? Okay. And if we are sitting there and we sell an asset out of the general fund for $500, we simply do what? We simply debit the cash, credit the, and this is considered either an other financing source. I've also seen it called other revenue. I've seen it go both ways, and I asked MGO, well, when do you know if it's other revenue or other financing source? And they said, we don't know. Okay, if you're going to look at your pictures, at least bother to not do them in the front row, okay? Okay, so you go ahead and you do what? You debit cash and you credit the other financing sources, or it could be what? Could be other revenue, and I'm not sure when they use. I've seen them use both. Okay, debit cash, credit other financing sources. Okay, for 500. Now, if I'm accounting for that same transaction, governmental activities, I have to do just like I do in commercial, don't I? Okay, so I have to go ahead here and debit my cash for the 500, debit the accumulated depreciation to take off the depreciation, credit the equipment, and credit the gain on the sale of equipment, right? Are we going to get to the point where I got to ban the cell phones? Is that what I got to do? Just no cell phones? I'm thinking you should be able to keep your cell phone there like an adult, and if something comes up that's important, you do one of these and then you put it back down, right? Or you rush out of the room. I don't know if they say mommy's ready or whatever it is that they say at that point that you got to rush out, you do it, right? Okay? Otherwise, leave the phones alone. Okay? All right, so what's happening? We say that we do what? Just like we would do in commercial, wouldn't we? Right? Take the assets off the books and recognize a gain for the difference between what you sold it for and the book value. This asset had a book value of 0 because the accumulated depreciation was equal to the original cost of the asset. It was fully depreciated, right? Okay. Okay, good. Let's take a look at the capital project fund. And when we look at the capital project fund now, we're going to see that we will use this if we are constructing assets such as street lights, such as not street lights, but a county courthouse, something like that. Okay, I'll come back to the special assessment later. What I want to do right now is just walk through how we will keep track of constructing this asset if we're doing the capital project fund. And I think what I need to do here is bring up a separate tab so that I can keep track on this pad 2 accounts that I think help us to understand what's going on with this. And then I hit hide to go back. Okay, so I know what I need to do. Okay, so let's just go ahead and let's take a look at this example. Okay, and we're using the capital project fund now. And I'm going to keep it like this so that I can just kind of toggle back and forth to the pad, etc. You got enough room here, right? Yeah, I mean, you can see this okay, right? Okay. All right, so what happens? We're going to get a federal grant that's going to help us to fund this city office building. Sometimes the federal government will give us money for something like this. Maybe they'll give us money for a county courthouse, whatever. Okay, so when we get notified that we have this grant, apparently there was no time requirement on this, and there was no eligibility requirement on it because they took it into revenue, didn't they? So they debited the due from federal government and credited the revenue for $100,000. Okay, governmental activities, similar entry. It's still revenue. It's still what? Due from the federal government, but now they're calling it a capital grant. Remember, one of our program revenues here, right? Okay, so just a little bit of a different account that we're using. So then what happens? Then we come in and we haven't received that money from the government yet, and we want to get going on some blueprints or something like that. So remember we talked about when there's a transfer over of money, but there's an expectation that we'll repay that money to the other fund, like the general fund. We set it up as a loan. Okay, so we set this up as a loan. This is a loan from the general fund to the capital project fund. And the reason I brought up that pad is I'm going to keep track of my cash in this example, and I'm going to keep track of my expenditures. And I guess I could have done it on a word pad too. But anyway, okay, so I'm going to keep track of which 2 accounts? Cash and expenditures. And the reason I'm doing this, guys, is just because it helps to see how this thing ends up, because they'll go through several transactions and it gets a little confusing to see exactly where they ended up unless you understand what's happening with cash and with the expenditures. And did I just receive $50,000 cash? Right? That loan. So I debit cash for $50,000. And the balance, therefore, in the cash account is how much? 50,000, right? Even I can do that one in my head. Okay. Okay, good. So now let me go back and let me take a look back at the problem here, back at the example. So that cash has come in, and I have to pay that money back at some point, and I continue on now. I don't want to put it in slideshow mode so that we can get back and forth, okay? Then what? Then they go ahead and they order the architectural work. And so they debit encumbrances and they credit budgetary control. We're still using our encumbrance accounting, aren't we? Okay, so this is why I wasn't too concerned about making that first test pretty easy, because I knew that you're still going to have to rely on that stuff in here, right? For these examples, okay? Okay, good. Then what? Then I come over and the guy does the work. The architectural company does the work. So I debit the budgetary control, credit the encumbrance for the original amount, debit my expenditures in my capital project fund, and credit the cash, right? Now, at the government-wide level, since I'm using full accrual accounting, I'm going to capitalize that as a work in progress. It's an inventory, isn't it? It's an asset, but it's an expenditure at the individual fund level. But I have spent $48,000 cash, haven't I? So let me come back to my, meanwhile, back at the pad, we're going to go ahead and do what? Credit cash for $48,000? So now the cash balance is down to what, 2,000? And my expenditures were how much? 48,000, right? Okay. Just a theory I have. I'm thinking it's easier to understand this stuff if your eyes are opened. If your eyes are closed, this all of a sudden is like watching it on radio. And if you're fall asleep, then what happens is this. You're rowing down a beautiful stream somewhere, and there's a beautiful person in the other end of the boat, and you're going, oh, I can't wait till we get there. And meanwhile, there's some guy on the shore going, then we'd have a credit expenditure, debit expenditure, and keep track of our cash. Ruins the dream, right? Okay, so don't disrespect your sleep. Don't disrespect your study governmental accounting, and you'll be in good shape. All right? Okay, so let's just come over. It's human to fall asleep. It's my job to wake you up. Okay, now you come over and you take a look at, and of course at the government-wide level, we would debit construction in progress. Then what? Then we go ahead and we need some money, so we issue some bonds on this thing, don't we? Okay, and when we issue some bonds on this thing, we go ahead and we get the cash, we credit the other financing sources, and notice it's only for the $5 million. Did these bonds issue at a premium? Yeah. These bonds issued at a premium? They issued it more than face, and the premium on the bond, we're going to say, is due to the debt service fund. Often, the bond covenant will read that any premium amount needs to be sent to the debt service fund, because who's going to end up paying back the principal and interest on this? The debt service fund, right? It's their whole job to pay back this money, both the principal and interest. When you go to vote in 3 weeks, you're going to probably see initiative on the ballots that's going to say, do you approve the issuing of bonds to construct blah, blah, blah on the other? And what happens? Everybody always says, sure, just issue bonds and construct a thing. But you got to think about what? The fact that that money has to be paid back, and we have to pay what? The interest on that, and that's going to be paid by somebody, the debt service fund. But where's the debt service fund going to get the money? Often the general fund is the one that ends up transferring the money over to the debt service fund, and so money that could have been used for some other purpose ends up getting used for what? That bond initiative that you approved 5 years ago or something stupid like that, right? Okay, so watch out for that. Okay, but what happens? It really depends. Do you think that use of funds, regardless, is a useful? Don't be fooled by the fact that it's a bond, right? Still got to be paid back. Okay, but what's happening? We're sitting here, and we're setting that up as due to, and notice that what? It's other financing sources. Oh, I can't write on it when it's in this mode. But notice here, guys, that what? At the government-wide level, it's just like you would in commercial accounting. You're setting up the bond payable, you're setting up the premium, aren't you? Just like commercial? Is that what you would do in commercial? Debit the cash, set up the bond payable like that. Okay? Okay, good. Did we get some more cash? We got some more cash, so I guess I better go back to my pad, right? How much cash did we get this time? 50 million, wasn't it? Oh, it's 5 million? 5,050,000? We can't build anything for that. 5,050,000 like that? Okay, so now we have what? 5,052,000 sitting here? Okay, good. 5,052,000. Lots of time left. Okay, all right, good. And just for the heck of it, do you mind if I keep track of the due to? Debt service fund was how much? 50,000? You don't mind if I keep track of that, do you? Okay. Okay, good. Except you may mind where I wrote it because I'm going to now need more room for my cash. But let's see. I may be able to squeeze it all in. Okay, so let me go ahead and hide that. And let me come back to the problem here now. And I'm going to go ahead and I suppose I'm going to start to use some of that money. Okay, so what happens? Oh, no, here comes that cash that the federal government finally gave me the cash they were going to give me. Remember they were going to give me 100,000 and I set it up as a due to? Up here, the federal government, maybe you were sleeping during that. The federal government was what? Going to send me some money, weren't they? And I set up as a revenue? So this is simply now what? Simply now the collection of that money? Okay, did I get some more cash? Okay, so I'm going to go back to my pad and I'm going to put my cash in there. How much is it? 100,000? So I debit the cash 100,000. So now I've got what? 5,152,000. Good. Okay. Okay, good. So now I go ahead and I go back to the problem. And the general fund says, I understand you were visited with a little bit of money from the federal government. You want to give me my 50,000 back now? Okay. And so what happens? We got to pay him the 50,000 back, don't we? Okay. So we go ahead and we send that money back to my general fund. And so I go back to my pad. I go back to my cash here, and I just credited cash for how much? 50,000? So now I'm 5,052. No. 5,000,000 1,102, right? I always make that mistake on this problem. 1,102,000. Why can't Microsoft do this thing up here? I don't understand why they have to make it so difficult for me to change my pen. But anyway, okay, so 5,102,000. Okay, so I can go ahead and I can hide that, and I can come back to the problem. Okay, so I paid back the loan. I don't owe the general fund that money anymore. And now I start construction. And when I start construction, I still use my encumbrance accounting. So I debit my, I must have skipped one, right? I debit my encumbrances. I signed the contract now for 5,050,000, right? So I debit my encumbrances. I credit my budgetary control. And the guy sits here and sends me a bill for partial work, right? And so what do? I go ahead and I debit the budgetary control for 3, credit the encumbrances for 3, set up my expenditure and set up my contract payable, right? For 3 million, and apparently the amount that he's charging me is just what he estimated me, right? So I don't have a difference between my encumbrances and my actual expenditures. At the government-wide level, I'm going to set up the construction in progress because, again, I'm building up that capital asset up there, right? Okay. Okay, good. Then I go ahead and when I pay the guy, I hold back a little bit. Anytime you have a contractor doing work for you, I don't care if it's your house or whatever, you never give the person all the money up front until you know they're done, right? One time I was having some work done at my house, and I wanted the guy to change the side of my house where the sun had warped and split all the boards and everything. The wood, there was like a wood siding on part of the house, and it was facing west. So the sun had done a number on that over the years, right? So he says, "Do you want me to replace the wood?" I said, "No, stucco the whole thing. Just stucco the whole thing, because I don't want to have to do this again in 10 years or something stupid, right?" So he says, "Okay, fine." So he stuccos the whole thing, but there's a little corner on the other side of the fireplace that he leaves wood. And I'm like, "Well, why didn't you change that out too? I want it all to match." "Well, that one wasn't warped." "Well, I don't care. I said the whole thing." So he says, "Well," I said, "Well, I'm not going to pay you for any of it until you do that little piece." Do you think he did that little piece? He had it done like sort of the next day. The only thing that was weird with that whole story is he came and he rang my doorbell, and I was right in the middle of shaving my head. And I'm like, "Who's ringing my doorbell now?" And I've got shaving cream on my head, so I grab my baseball bat because I don't know who it is, and I come to the door. "Yeah?" With shaving cream. And he goes, "Ah!" But anyways, that was the funny part of that story. But he did fix. But you always retain a piece, right? So they do retain some, don't they? Okay, so they retain a little bit. This $2,850,000 though they pay out up front, and so we go ahead. Did we use some more cash? So let's update the cash. We're going to go ahead and credit it for what? $2,850,000. And so now I have in there what? $2,252,000. 2,252,000. And of course, I'm going to have to move the due to the debt service fund. I should have known. For what was it? 50,000. Okay. Okay, good. So let me go ahead and hide that, and let's go back to the example. And so we're building this thing, aren't we? Okay, we're paying some of the bills here. We go ahead and we spend now an additional $2,050,000 on this thing. Oh, I forgot to set up my expenditures, didn't I? Forgot to put the expenditures in, because what did I spend on this thing? $3 million. I debited expenditure for $3 million right there, didn't I? Right? Right there? So I forgot to keep track of my expenditure because I spent another $3 million. So let me go back and let me fix that. I spent $3 million on this. Okay. Okay, good. So now let me come back, and I'm going back to the example, and I continue to build this thing, and I continue to pay on it, and now I spend $2 million, and they tell me that the project is done. So since I'm spending $2 million, but I had originally encumbered a full amount of what? $5,050,000. I've already recognized the encumbrances for what? For the $3 million. So now I can take the remainder out of the encumbrances, the remaining $2,050,000, right? How much did I encumber originally? No, I originally encumbered $5,050,000 right there, right? And then when the stuff came in, I just went ahead and debited my budgetary control credit and encumbrance for $3 million, right? But now the thing is completely done, they tell me, so I have to take all the money that I encumbered out of there, right? You reverse it for the original amount, don't you? right? You reverse it for the original amount, don't you? Okay. All right, so that's all that happened there. And I go ahead and I debit my construction expenditure. I credit my contract payable. I have a retained percentage, so I go ahead and if I go back to my pad, the expenditure was how much? 2 million? And how much cash did I use? I used 1,900,000 of cash because I'm retaining a percentage. So now my cash is down to what? 352,000. Right? Okay. Okay, good. So I come back now and I'm pretty much done with this project. And so let's see what's going to happen. I come over and I go ahead and I pay now the retained percentages. In other words, I did my inspection and the guys fixed it and finished or whatever, right? So I pay them the rest, which had been retained. Okay, so now I'm going to go ahead and just go back to my pad and I'm going to credit cash. What was it? 250? 250 credit. And when I do that 250 credit now, I end up with 102,000 in here. Okay, good. So I've got this 102,000 that's left. And I come back to the example. We're almost there. And what happens? Now I can go ahead and I can do my closing entries because it's the end of the year. And I forgot to keep track of my expenditures, didn't I? Okay, so my expenditures, let me go back to my expenditures. Kind of blew the whole idea of keeping track. Oh, no, I'm good. I'm 5,048,000 on the expenditures, right? Okay, and so when I go ahead now and I do my closing entries back at the example, I credit my expenditure for 5,048,000 because I'm closing that, right? So I'm going to close my expenditures. Okay, I'm going to close my other financing sources, the 500,000, and I'm going to close the revenue. That was the 100,000 revenue that I had set up way up here for that money from the federal government. Wasn't that revenue? The money from the federal government, wherever it went. Where'd you go? Money from the federal government. There it is. Remember that revenue from the federal government way up there? Okay, so when I'm getting down to the closing entries, I'm going ahead and oh my God, I found this. What were the odds? And I go ahead and I do what? I debit the revenue to close those. I debit the other financing sources, 5 million to close those. Hadn't I set up the other financing sources for 5 million? Right? I credit my expenditures to close those. So 52,000 is going to go into my fund balance here, right? Now that money is restricted. That's not, hey, funny money that you can play with. That money was from a bond. It was restricted that said I have to use the money for what? The whatever we're building here, this office building or whatever, right? So the money's restricted, isn't it? But I do have 52,000 sitting there. So what do? I go ahead and I take that 52,000 and I transfer it out, and they're telling me here, do they tell me where I transfer it out to? No. Probably the debt service fund. Okay, they're not saying here, but I'm thinking that's going to the debt service fund. But it certainly is money that's coming out, isn't it? Okay, and then what? I go ahead and I close out the transfer out now to fund balance. So the fund balance is 0 in this fund now, isn't it? For a minute it was 52,000, but I immediately took the 52,000 and sent it out, didn't I? And so now it's 0. Okay, when I close out my transfer out. So when I look back at my pad over here, what? Because usually, because it's money that came from the bondholders. This money came from the bondholders, didn't it? Any money I had that came into this fund either came from I got 50,000 from the general fund, which I've paid them back. I got 100,000 from the federal government. The federal government wasn't playing around. They said, hey, you have to use this for this courthouse, right? So whatever it is they're building. So I used all that in there, and so I was left with 52,000 of funds left, which needs to go, and I'm saying they probably transferred it to the debt service fund, even though they don't show you that part here. It went to the debt service fund, right? Okay, so let's see how much cash I have left. I sit here, and didn't I just credit the cash for 50,000? Well, I mean, what was it? 52,000, excuse me, right? I credited for 52,000, right? Because I sent that 52,000 over. Let me fix that. 52,000. So now what's the balance here? Now the balance is 50,000. Why don't I go ahead and pay my buddy the debt service fund their 50,000 now, right? For the premium that was left? I haven't paid them yet, have I? Have I paid them yet? And even though the slides never show, the slides just kind of forget about that 50,000, I'm going to go ahead and I'm going to be a thorough accountant here, and I'm going to debit what? Due to debt service fund for 50,000 and credit the cash, right? And when I do, that 50,000's gone too, isn't it? So now the balance in the cash for this capital project fund is what? Is zero, as it should be. I either spent the money on the construction of this thing, or I sent it to the debt service fund, which is the restrictions associated with the capital project fund usually. Right? Yeah. We paid two amounts, but we held back whatever it was, 15% or whatever it was. And then we finally went ahead and caught that up and paid the whole rest of the amount out. All of those were credits to cash. Those were all credits to cash. All we did, and I almost wish they wouldn't even bring in this retained percentage because it doesn't really help us understand what's going on with this money. But we went ahead and we paid, but when we paid $285. That was a credit to cash. And then we went ahead and when we paid the rest, we paid, well, not the rest, but we paid the 1.9. And then we went ahead and did what? A little bit later, we went ahead and paid the amounts that had been retained, right? So we paid everything out of the cash. Okay. Now, if you sit there and you think about, well, where were all the resources? How are they working? So let me go ahead and put that somewhere, maybe right. Can I put it right here? Okay, this is just an analysis now, and I had revenue of 100,000, didn't I, from the federal government? That was that federal revenue for 100. I had the bond. I'll just put Fed revenue up there. I had the bond for what, 5 million? So I had a total available of 5,100,000, right? Right? I spent, what was the total here that I spent? 5,048,000, didn't I? Isn't that total right there? I spent that on the construction of the courthouse, or whatever this thing was, the office building, 5,048,000. How much was left? 52,000 was left, and I sent that to transferred it out to the debt service fund, didn't I? Now, in my little analysis here, I didn't include the 50,000 that was what? That came in, because it really was already earmarked right out of the gate due to the debt service fund, right? It didn't run through my operating statement, so I just went ahead and ignored that. That was purely a balance sheet transaction. Cash due to somebody, and we saw that we would have gone ahead and transferred the cash out this way, right, by debiting the due to and creating the cash. So I left that 50,000 out of my analysis. But basically, the money that came into the capital project fund was all restricted for the construction of this office building, and I used the capital project fund to keep track of that money as I spent it, as the bondholders told me I should have, right? Okay. Okay, good. And then what? Then we come back to the example, and I'm going to go back to slideshow mode now because I'm not going to go back to that pad anymore. We come over just catching ourselves up, and of course we have to do what? We have to record the building at the government-wide level now by debiting the building and crediting the construction work in progress. The capital project fund for this thing is gone now, isn't it? That capital project fund is completely closed out. We've either used the money for the construction or we sent it over to the debt service fund, didn't we? Any money that came in? Okay. Okay, good. No, I don't care about this. Okay. So, this is your job. This is your assignment. You need to go to City Hall. No, okay. You need to go to Hayward and find the pitchforks. Okay, no. You need to take the Chapter 5 quiz and work through that. Okay, and you should be able to answer a good chunk of that now after this scintillating conversation, after the stimulating discussion that we had, and we went through that. If you're sitting there and you're not understanding some part of this, go back, look at it. If there's a question, you can look at the lecture part. I'll have it up there probably by tomorrow or so, I guess, and you can go ahead and look at that part if you need to look at that part of the lecture. Otherwise, you should be able to work your way through those questions. We'll reconvene, obviously, on Wednesday. We'll go through the homework questions. We'll jump ourselves into Chapter 6, okay? And we're just going to continue that process as we head into the second midterm. All right, guys? Okay, have a good rest of the week. No, keep the Scantrons, keep everything. Okay? If you have something you need me to consider, I'll look at that. Carolyn?
When is the next Connect Plus assignment going to be posted?
I'm not posting Connect assignments in here. I haven't been posting those. Was there supposed to be? Was I posting them?
I thought so, because if we have homework, 5% of our grade, you posted the first
The
four.
quizzes are 5%. I don't believe that I was posting homework in Connect, but I can look in there.
You did for the first 4 chapters.
Did I?
Yeah.
Okay, I can look in there and post some more things. Send me an email on that, and I'll look at it, and I can post some things. I can put some things up. I'll probably put some journal entry type questions.